everybody, literally everybody knows that the GST is a big deal. Experts have hailed it as the most significant reform of the past several decades, and with good reason. So I'm sure you know the GST is big, but do you know why the GST is so big? That, my friends, is the whole purpose of this course, to help you understand the ins and outs of the GST. Since GST is going to revolutionize the tax structure, it makes sense for us to start with what the current state of affairs is today. After which, we will see how the GST is going to change our lives. We'll talk about the GST in detail, exactly what taxes apply, the terminology used, and how it will help the domestic industry, etc. We will also learn about the taxable event when the government can levy the GST and run through a brief timeline of how the GST came to be. Let's begin with the current tax structure in the Indian economy. It can be broadly divided into two main categories, the direct taxes and the indirect taxes. The name itself suggests that the direct taxes are borne by the person liable to pay, that the burden of such taxes cannot be shifted. Whereas in indirect taxes, the burden of tax can be shifted. The person liable to pay tax can collect tax from somebody else and then pay it to the government. The GST falls under the indirect taxes category, and that's what is going to be our area of focus. The current indirect tax structure can further be divided into two broad categories, the central tax and the state tax. The central tax is levied by the central government and the state tax is levied by the various state governments. Just a little warning before we move ahead. The number of indirect taxes which exist in our tax structure today is mind-boggling. Under the central taxes, you have the service tax, CST, customs duty, excise duty, additional excise duty, CVD, SAD, excise duty under the Medicinal and Toiletries Preparation Act, and surcharges and cesses on all of these central taxes. Phew! And that's just not it. On top of all of these central taxes, there are also the state taxes, which include VAT, purchase tax, octroi and entrance tax, entertainment tax, luxury tax, taxes on lottery, betting and gambling, and surcharges and cesses on all of these taxes as well. So, when you combine the central and state taxes, there are just way too many taxes in the current tax structure. Just too many. You agree, don't you? Apart from having a plethora of indirect taxes, the current tax structure has another major problem. In fact, a bigger problem. That is, when you buy something, you're in effect paying tax on tax. This is called the cascading effect. The best way to clearly understand cascading effect is to look at a numerical problem. But before going into a numerical problem, we'll touch base on certain concepts, like the input credit. More often than not, manufacturers, sellers cannot claim input credit under the current tax structure. What is exactly input credit? It is basically the tax that is paid by manufacturers or sellers on their purchases. And this tax already paid by them cannot be claimed or reduced from their output tax, that is the tax that they'll have to pay on their sales. This is input credit. Taxes paid on purchases can be reduced from taxes payable on sales. If this is the case, then you are set to have input credit. If not, then you cannot claim input credit, that is you cannot set off your output tax liability. Time to move into our example. Let's take the case of manufacturing a shirt. First, let's look at the processes involved, because tax is levied at each and every stage in the entire production process, right from manufacturing to distributing to final sales. We can now move on to our numerical example. For that, let's draw up a table. The first column would be the action as to what are the people involved in this process of production doing. Second is the cost, that is what is the cost for doing that process. Third is tax, and the fourth column is the total of cost and tax. There are two assumptions that we've made, that the tax rate does not change throughout the process. It is at 10%, and that none of these people have included any profit. So everything is at cost. This is just to simplify the example so that we can understand better. It does not make a difference if the tax rate changes or the profit is added. It just changes the calculation, that's it. So these two assumptions are just to simplify the process. So now let's move to the first stage in our production process. The manufacturer will buy raw material. The cost of raw material is 100. He will also have to pay a tax at 10% on this raw material. So the tax on cost of 100 would be 10. The total cost that the manufacturer will have to bear for his raw material would be 100 plus 10, 110. This raw material moves into the next process, that is of manufacturing the shirt. It is assumed that in the manufacturing process an additional cost of 40 is incurred. So after the shirt is manufactured, the cost would be 100 plus 10 of raw material plus 40 manufacturing cost, that is 150. Adding a tax at the rate of 10% of 150, that is 15, the total cost of shirt after manufacturing comes to 165. The next process, wholesale. Again, the value added is 30. Same as we did for manufacturing, the cost would be 165 plus 30, 195. Add tax of 19.5, cost would be 214.5. Last stage is the retail, that is the final sales stage. A value of 20 is added, so the cost would be 234.5. Add to that 10% tax and the final cost of the shirt is 257.95. Notice that the cost without any tax is 100 plus 40 plus 30 plus 20, that's just 190. To this, a tax of 67.95 is added. Let's try and understand the taxes better. Now, when the manufacturer buys raw material, the tax he's paying is VAT. In the second stage, after manufacturing, the tax is excise. Third stage, when he sells it to the wholesaler is paying a VAT and the retailer is paying GST. Now that our example is set, we are going to understand what cascading effect really is. Notice in the manufacturing stage, tax of 15 is paid. This 15 is on a cost of 150. Now this 150 includes 10 tax of the earlier stage. This is what is meant by tax on tax. In the next stage, the tax of 19.5 also includes tax on 10 and 15 of the previous stage, and the same is the case with the last final consumption stage. And this is the concept of tax paid on tax. Why did this happen? This is because input credit cannot be claimed in any of these stages. Let's understand that. VAT, excise, VAT and GST were the taxes paid. VAT is a state tax, whereas excise and GST are both central taxes. As per the input credit rules, central taxes and state taxes cannot be claimed against each other because you're paying central tax to the central government and state tax to the state government. So you cannot set off these two tax expenses. Let's look at GST in particular. GST credit is not allowed at all. That is, if you've filed all C forms and everything is in place, GST input credit is absolutely not allowed. Another restriction on input credit is that the state tax of VAT cannot be claimed against any other state taxes like luxury tax or entertainment tax. So VAT can be set off only against VAT and not against any other state taxes. These are the restrictions on claiming input tax credit. There are many more restrictions. These are just the examples which match our numerical problem. And that's why none of these taxes can be set off against each other and our total tax liability is $67. This is a major limitation on input credit. we've seen the cascading effect in detail through our example. Cascading effect is tax paid on tax, which is a fallout of the current tax structure which imposes some major restrictions on claiming input tax credit. You think you pay too much of tax? Don't worry, GST comes to the rescue. In fact, reducing the cascading effect of tax would be one of the major achievements of the GST regime. Let's check out how the cascading effect would reduce under GST. Let's bring back our example on cascading effect. We've already seen that we pay tax on each of the three stages: manufacturing, warehousing and retail, that's final consumption, and the total tax comes up to 67 because of cascading effect. Let's see how this would change. This exact example would change under the GST regime. We'll have to add one more column to our example. This column is for the actual liability. It represents the actual tax that each of these individuals will have to finally remit to the government of India. You'll understand what actual liability is in detail as we proceed through the example. So let's just start with our first step, where our manufacturer is buying raw material. We know that the cost of his raw material is 100, on which he pays 10 rupees as tax at 10%. His actual liability would be 10, and the total cost would be 100 plus 10, 110. Moving to the manufacturing stage, we know that the cost of manufacturing is 150, similar to our previous example. 100 raw material plus 40 value added and 10 of tax on the raw material. That's how you get 150, 100 plus 40 plus 10. Now, because this is the next stage of handshake in the supply chain process, the government will collect tax here as well. At 10% on the cost of 150, the government will collect 15 rupees as tax. But under GST, input tax credit would be allowed. And so, the manufacturer had already paid 10 rupees on procurement of raw material. His output tax liability, that is his liability on sales, is 15, and he can claim credit of the 10 he's paid on purchases, and his net liability to government, the amount that he has to finally remit to the government, is only 5. 15 output tax liability minus 10 input tax credit, 5. The total cost would be 150 plus 5 of tax, 155. Note that we've assumed that there are no profits involved in our example, just to make it simple. The cost after the wholesale value add is complete is going to be 185. How? 155 plus 30 value add. Take a note that this 185 includes tax of 15, 5 from the manufacturing stage and 10 from the raw material stage. We would proceed just as we did for the manufacturing stage. 185 for the wholesaler would attract a tax at 10% of 18.5. Now, since this 185 already includes a tax of 15, he can claim input tax credit of that amount. That's why his output tax liability, actual tax payable to the government, would be 18.5 minus 15, 3.5. The total cost at this stage of our shirt is 188.5. So the cost after retail process is over is 208.5, 188.5 plus 20. At this stage, 208.5 includes tax of 18.5, 10 from raw material, 5 from manufacturing and 3.5 from wholesaler. Same process as we did for manufacturing and wholesaler. 208.5 would attract a tax of 20.85, but because 208.5 already includes tax of 18.5, the retailer can claim input credit of 18.5, and his net liability payable to the government would be 20.85 minus 18.5, that's 2.35. The total cost of the shirt is 210.85. 190 is the total cost without any tax included, that's 100 of raw material, 40, 30 and 20 value added, 190. And to that we add a tax of just 20.85 to get 210.85 as the total cost. Compare this to our earlier example where no input tax credit could be claimed. The cost was 257.95, almost 258, and now it's just 211. So that's a flat saving of 47 on one shirt. That's just one shirt in our hypothetical example, but the mechanism works overall. So apply this logic to every product or service that is sold in our entire country. Can you imagine the kind of savings that GST would bring about? And that is the magic of the goods and service tax. This is how GST would reduce the impact of cascading effect on taxation and reduce cost of goods and services across the nation. We've seen earlier that the current tax structure has two major problems. One, of the cascading effect, and two, that there are just too many indirect taxes out there for people to comply. The role of GST is not only limited to reducing cascading effect, but also to counter the second major problem. We've already seen that currently the Indian government charges central tax as well as state taxes. The central taxes include a wide plethora of taxes like excise, CST, the list goes on and on. Same is the case with state tax, with VAT, luxury tax, entertainment tax, on and on and on. This wide plethora of taxes is going to be combined into just 3 taxes under GST. The two broad categories of indirect taxes would still be there, but they would not be center and state taxes. Instead, they would be called interstate and intrastate taxes. Interstate represents sale of good between two states, and intrastate stands for sale of goods within one state. These will be the broad two bifurcation of indirect taxes under GST, which replace central tax and state taxes. Under interstate taxes, you'll only have one type of tax, the IGST, which would be levied by the central government. And under intrastate, you will just have two taxes, the CGST and the SGST. CGST would be levied by the central government, whereas SGST would be levied by the state government. That's it. All of the 16 odd wide varieties of taxes under the central and state taxes would be subsumed under GST, and there'll only be 3 taxes, the IGST, CGST and the SGST. The I in IGST stands for integrated. The C, very obviously in CGST, would be for center, and S would be for state. An important point to remember is that the intrastate taxes, both the CGST and SGST, are concurrent taxes on the same base. That is, if you purchase a toothbrush, you would be paying both CGST and the SGST on that toothbrush at the prescribed GST rates. So it's a concurrent tax on the same base. We'll discuss about the prescribed rates sometime in future. For now, this is the point that you need to remember. GST in intrastate is a concurrent tax. Another important point that you need to remember is that under all these 3 GST taxes, custom duty would not be included. Custom duties is a tax on imported goods, and it will be levied in addition to GST on all imported goods. That's the structure of GST for you: IGST, CGST and SGST, where customs duty is not included. That's it. Super simple, super clear. At this juncture in our discussion on GST, you would be wondering, so what exactly is the GST? Here's the definition. The Goods and Services Tax, the GST, is a comprehensive, multi-stage, destination-based consumption tax on value addition. Complicated? Well, it isn't so much. Let's break the definition down. Let's focus on the terms first. What does multi-stage mean? It means that the GST would be levied at each and every stage in the entire supply chain, right from manufacture to distribution to final consumption. At each handshake, when the good moves from one person in the supply chain to the next, GST will be levied. That is what multi-stage means. And to understand multi-stage clearly, what you need to know is what supply chain includes. To understand the stages of supply chain, we'll bring back our example. We'd seen that the manufacturer buys raw material. So that's one stage of a supply chain. And then he manufactured the shirt. So manufacturing is the next stage. After manufacturing, he shipped the goods to the wholesaler or the distributor who warehoused the goods. So the next stage in the supply chain would be distribution and warehousing. The wholesaler then sells off the goods to the retailer who sells it to the final consumer. So that's the next stage, final consumption. In between all these stages, there's a handshake. The manufacturer gives it to the wholesaler gives it to the retailer, and there's logistics involved as well. GST would be collected at each of these stages. So that's what is the multi-stage in the definition of goods and service tax. What's value addition? Again, we'll go back to our example. The manufacturer first bought raw materials. So he bought yarn, which he weaves into shirts. So he manufactures lots of shirts and ships them to the wholesaler who then adds labels and maintains inventory. The retailer gets all these shirts in bulk from the wholesaler and then adds value to the shirts by providing single piece packaging and markets these shirts to the final consumer. All of these processes are involved in getting you the shirt you're wearing. At each stage in the supply chain, a value is added. In our hypothetical example, a value of 40, 30 and 20 respectively is added at each stage of manufacturing, warehousing and final consumption. The tax in GST is only on such value added, that is on the 40, 30 and 20. But what would be the mechanism of calculating such tax? Obviously, the government cannot track the cost at each stage. The mechanism would be to allow input credit on taxes already paid. On the purchases, the manufacturer, wholesaler and retailer would have paid taxes and they can claim these as input credit deducted from their tax liability on the sale. That's how GST is a tax on value addition. The last term in the definition, destination-based consumption. This is a big shift from the current tax system, so it's important to understand. Looking at the term destination-based consumption, you should ask yourself, where are the goods or services consumed? Where is the place of final consumption of goods and services? The taxing authority having jurisdiction in the final place of consumption collects the tax on such goods or services. So let's understand this further. Let's take an example. There's a manufacturer in Rajasthan who ships goods to Karnataka where the final consumer buys such goods. The final place of consumption is Karnataka. The government of Karnataka will collect taxes on such goods. The manufacturer is in Rajasthan, so Rajasthan is called as the producer state, whereas Karnataka is called the consumer state because the final consumer is in Karnataka. There's producer state and consumer state. Where is the tax collected? In the consumer state. The tax revenue is for the consumer state and not for the producer state. So this is a huge shift. Remember that excise duty is collected on manufacturing, that is, it's the revenue of the producer state. And this is the main reason why many states were opposing GST, because they'll lose out on revenue. Well, but there are lots of advantages of GST being a destination-based consumption tax, and we'll talk about those later. For now, we've discussed the domestic transfer of goods between Rajasthan and Karnataka. What about imports and exports. How do those work? Let's take a look. Our manufacturer is in India. He produces goods and exports it to the USA. The final consumer is in USA. The place of consumption is the USA. Now we know that taxes are levied in the place of consumption, and India definitely has no taxing authority in the USA. It's a separate territory after all. What would this imply? Simple, that exports are not taxable. Under the GST regime, exports cannot be taxable because of destination-based consumption rule. Let's look at it the other way around. That is, the manufacturer is in the USA and he sells the goods to the final consumer who is in India. The place of consumption would be India. We know tax is levied in the place of consumption, and the Indian government definitely has jurisdiction to collect tax in Indian territory. So Indian government can collect tax, and this implies that imports are taxable. There's an interesting inference that can be drawn from this. Imported goods are just the same as domestically produced goods when it comes to taxes. Tax on imports would be the same as tax on domestic goods. In fact, imports would be costlier because it would attract customs duty as well, which is not the case with domestic goods. With this move of converting taxes as destination-based consumption tax mean that exports from India are more competitive in the international platform. It also protects the domestic industry by making imports at par with the domestic goods. And so the GST tax regime would be a great support for domestic industries. With that, we've covered destination-based consumption as well, and that's the definition of GST for you. It's a multi-stage tax. Tax is collected on each stage in the supply chain. It is a tax on value addition by which it will help reduce the cascading effect, and it's a destination-based tax levied only on the final place of consumption, which boosts exports as well as the domestic industries. We've reached a point to ask ourselves, when can this tax be levied? When would the government be able to collect this tax? For collecting a tax, some event has to occur. Only after that, the government has the right to collect tax. And such event is called the taxable event. Tax can be collected after a taxable event has occurred, say manufacture, sale, or provision of services. So these are examples of some taxable event. In the current scenario, that is the taxable event today for excise duty is manufacture. VAT and CST can be collected on sale of goods, and provision of services would entail collection of service tax. So this is the scenario today. The taxable events are manufacture, sale, and provision. Can the government charge excise duty when a product is manufactured and VAT on that same product when it is sold? Definitely yes. This is the current situation where there are multiple taxable events which could lead to double taxation on the same products. And that's what the GST is trying to eliminate. The proposed taxable event under the GST regime, that is including all three, i.e. GST, CGST and SGST, is just one thing, that is the supply of goods and services. Another way how GST is simplifying the tax structure. Products are no longer taxed at multiple points. One product does not entail excise duty as well as VAT at different points of time, and that there is no difference between goods and services because you do not have two types of taxes, VAT as well as service tax. It's just GST. So there is no distinction between goods and services. Why is this important? Ever noticed on your restaurant bill you pay two taxes, the VAT as well as service tax? Why? Because in a restaurant you're consuming food, so that is a product, goods, and that the restaurant is providing you services by letting you eat in their place and the waiter serving you food. So those are services that the restaurant is providing. So you pay VAT as well as service tax, and there's always a lot of confusion on how to bifurcate such combined products into services and goods. And that's what GST will eliminate. You wouldn't have to pay two different types of taxes anymore, and that's a major step forward. So from everything that we've discussed so far, GST seems to be doing a lot of good to the economy. It's going to bring about a simpler tax system throughout the economy by reducing the number of taxes that are there. It will mitigate the cascading effect of taxation. No tax on tax, or at least reduced tax on tax. It will improve compliance as well as revenue collection because of simpler processes, and that it will make exports more competitive in the international market by not levying tax on exports. And of course, the destination-based consumption taxation would be a major boost for domestic industries because imports and domestic goods would be treated the same. But everything is not all rosy when it comes to GST. There are some cons as well. Local dealers would have to pay CGST as well as SGST. Why? We've discussed that CGST and SGST are concurrent taxes on the same good. For services, you would have to pay both the central as well as state taxes. Earlier, you only had to pay the service tax, which was only a central tax. Since GST is going to bring about uniform tax rates for all sectors, it could be possible that few sectors might end up paying more tax than they do right now because of higher rates. And we've seen that the producer states would lose out on revenue because all tax revenue would accrue to the consumer state. So they'll lose out on the excise duty revenue that they earn right now. Nevertheless, GST has lots of advantages on the entire economy when compared to disadvantages which are very specific to few citizens of the nation. When GST finally rolls out, it would definitely be exciting times in the entire economy. Let's look at how the government has been trying to implement GST. It started all the way back in 2006. The finance minister in the budget speech proposed 1st April 2010 as the date for introduction of GST. In 2007, the Empowered Committee, that's the EC of State Finance Ministers, constituted the Joint Working Group JWG, and the JWG submitted its report on GST to the EC. It's then that the CST rate was reduced from 4 to 3%. In 2008, the EC finalized its overall strategy for GST structure, and the CST rate was further reduced from 3% to 2%. Moving to 2009, it was when the first discussion paper on GST was released, and the 13th Finance Commission released its report on GST. In 2010, nothing major happened. So in 2011, the IT strategy for GST was released, and the Constitutional Amendment Bill was placed before the Parliament. In 2013, the SC tabled its report on GST. In 2014, the revised Constitutional Amendment Bill was tabled in the Parliament. In 2015, we are getting closer, the Constitutional Amendment Bill was passed in the Lok Sabha, and the Joint Committee constituted by the EC released its business process reports on GST. And finally, in 2016, the model draft law was released in the public domain in June. In August, the Constitutional Amendment Bill was passed in the Rajya Sabha, and the Lok Sabha passed this bill with all the amendments suggested by the Rajya Sabha. So this was the GST story so far.